Become a six-figure trader by trading less. This was a sell. So we took a sell trade on this. Trade less and make more. I'm going to take you to the charts. I'm going to show you how this works. Today I'm going to talk to you about a concept that's made me a lot of money over the years, and it can make you a lot of money in the future as well. And it's a simple concept. Trade less, make more. I'm going to take you to the charts and I'm going to show you the price action system that I've used for years and years that's been profitable for me. And then I'm going to take you and I'm going to show you the strategy that'll make you profitable in the markets. Hey, for those of you who don't know me, I'm Rob. And for those of you who do know me, I'm still Rob. Let's have some coffee and let's get on with it. Let's talk about trading. A lot of you might already know that we're swing traders, position traders, and even long-term traders. Trading 5-minute charts is deadly. 99% of traders lose money trading 5-minute and 1-minute charts. Whereas if you swing trade and take longer positions, only 70% of traders lose money. So you've got a bit of a better chance of actually making some money in the market. Before we go there and before we go and talk about all the 50-50s and the win rates and the strategy and how to make money, because you've got to get to the strategy at the end of this video. The strategy at the end of this video is the strategy that's going to show you how to become a six-figure trader, how to actually make money in the markets, not lose all the time, because that's what you're doing now, isn't it? You're struggling. That's why you're watching this video, because you're looking for a system that's going to make you money. There's a difference between system and strategy, and the strategy that I'm going to show you towards the end of this video is the life-changing moment for you. While you're there, pick up your free Forex book. I've got it there for you. I'll talk to you about it later in the video. Right now, let's go to the system, the price action system that'll give you high probability trades in the market. Do understand as we go to the charts that the charts give you a high probability trade. They're not the thing that's going to make you the winner. What's going to make you the winner is what I tell you after the charts. So let's go and see the charts, and then we'll talk about profitability. A high probability system of trading is the easy part of trading. The difficult part of trading is the strategy, which I'm going to show you after the charts. This is the easy part. High probability trading. How do we do high probability trading? These are just all of the favorites on the left here, the ones that we like to use. But shall we go and have a look at how we pick a high probability trade out of the markets? Let's just use this. It's the US dollar, Canadian dollar. We shall use that. Now, what I normally do is I'll go to the day chart. This is the day chart. And then I'll take it to a line chart. And then I shall draw in these levels. Let's take that up to there. That's a resistance level. Draw in a little block here. You get them on the side here. It's a C trader, if anyone is interested. Then you can just grab it over there. You can just weigh it in there. This is the support level. You can just draw it in. There's your support level. But what's actually happened here is this has broken through the support level. It could go back up to retest and then go down. But no, what we've actually got here is something much more interesting. This is a trend resistance now that I've drawn in on the short term. Now, why did I draw that in? If it breaks through a trend, then it is short. So, for example, if we take this trend here and you, oh no, what happened there? That's nasty. Don't do that to me. You draw that in there, you'll notice that at this level here, it broke through the trend to the downside. That called it short for me. And it also broke out of the support, giving us a clear signal that it's short. But it did it with candles. Why do I use candles? Candles show me the red. They show me the green. They show me the red candles coming out of support. They show me that it's short. But now bear in mind that we're trading on a slower time frame. We're trading less to make more. Now, the basis of that is you're looking for the trade on the higher time frames. I'm going to take this back to the candle so we can see it a little bit better. Now it's on the candles. You see we've had a big red candle that came out of there, another red candle on the day going down into the support, and the red candle breaking through the support to the downside. Very often they'll come back and retest before they go down, but in this case, it's coming up, hitting the trend resistance and heading on to the downside. The reason you can trade more is you can put your stop loss way up here and you can put your target profit down, way down here at the lower levels, looking for a longer term trade. And then you can leave this trade on the market. So if you were to trade this on the daily chart, you would take the short from here. If you wanted to trade it on the weekly chart, you can see clearly it's bearish on the weekly. You can take a weekly trade with a view to it getting all the way down to this demand level at 135. That would be a humongous gargantuan trade. But I like to trade on the 4 hour. The 4 hour is good enough for me. So on the 4 hour chart, I look at it on the 4 hour chart and I say, where am I on the 4 hour chart? It's broken through my support level. It has actually already retested, broken to the downside and headed on down. This is a great short trade. It's broken through its trend support, now basically a trend resistance, heading on to the downside, and it's looking like it might come back, test that trend resistance, and then head on down. So this would be a short trade. Now that's how we look at price action at the end of the day. And the reason that we're taking less trades to make more is now I can put my stop loss all the way up here at the 143.5 level, above these highs over here, the 143.750. Put the stop loss there. Work out my price or the size of my trade. Let's say the size of my trade. In this case, this account's $25,000 account. So we'll say $250. So we'll work out $250 from here back to my cost. And then I'll work out how many contracts I can have. Take that trade with a view to taking profit all the way down here, because you can clearly see that this is going to go pretty far on the recovery. The levels are down here at the 140, so you can easily put a 140 target in here on the 4 hour. You could even put a 138 target in, and right at the bottom is a 135 target, as you saw on the weekly. So that's how you can trade less and make more. So if you were trading on the 5 minutes, you would probably trade this like 10 times. You'd sit here watching it all day. Whereas with the 4 hour or the 1 day, you can literally take one trade, leave it in, walk away, come back and see what happens. Perhaps at the end of the week. I don't know. Perhaps at the end of the day, depending how long you want to trade or how quick you want to trade. A lot of guys like to go even on the H1. I prefer H4. 4 hours good for me. I take my levels from the day and the weekly. I get an idea of where the trade's going, and then I take the trade from there. So, for example, there's a couple of trades on this account, I believe, that we can look at. So, Aussie dollar, New Zealand dollar. This was a sell. So, we took a sell trade on this. Now, we've been in the trade since the 13th. That's already quite a while. It's in profit, and our target is down here. And you just sit in the trade and you wait for this. You sit on your hands and you wait for this to get down. I've already moved the stop loss up into break even, and it's a free trade. So you just wait for it, leave it there, and wait for it to get to where your target is. New Zealand dollar, US dollar, similar picture. Took it long, it's sitting, it's going. You just wait for it to get to its target, the target being way up there. That's how you trade these. You just take your time, trade less, make more. That'll turn you into a six-figure trader. If you want to do it on funded accounts, there is a link in the description below. If you've got the money to do it and cash to do it, get your brokerage account, put $100,000 in it and trade on it and see how it goes. You know, at the end of the day, a lot of people ask me this question, Rob, can I make money in the markets? Yeah, if you've got the money to invest, you can make the money in the markets, obviously. You're not going to turn $100 into $1 million. That's not how it works. You need to master trading. You need to get your psychology around trading, and you need to learn how to trade. And then you'll make that money in the market. So if you want to know how to do that, watch a little bit further and listen to my strategy after the charts here, and I'll tell you how you can make the money in the markets. This is just the squiggly lines. This is just the high probability trade that's going to help you to get ahead in the markets. Now you've seen the charts. Now you know how to trade with charts. Now you know how price action works. Easy, isn't it? I can teach that to a primary school child. But can you get your head around the markets? Can you get your psychology around making money in the markets? Whether you trade shares, whether you trade commodities, whether you trade Forex, whether you trade the moon, doesn't really matter. It's all the same at the end of the day. There's all a bunch of squiggly lines that go up and down, and those squiggly lines tell you whether to buy or sell. But all they do is they give you a high probability trade. They don't give you the actual win. A win rate in the market is completely meaningless, and I've told you this over and over and over again. And the reason a win rate is meaningless, guys, how can a win rate make you money? I know you're going to come at me with a whole bunch of stories about win rates, but at the end of the day, a win rate cannot make you money, and here's why. You can win 8 trades out of 10, and you can come to me and say, Rob, I've got an 80% win rate. I'm a genius, man. I know everything about the stock market. And you can give me all these abbreviations and tell me the market's fractal and all this rubbish. But at the end of the day, all you've got is an 8 out of 10 win rate. So if you win 8 trades out of 10 and you win $10 a trade on those 8 trades, you've won $80, right? What happens if you lose $200 on the 9th trade and another $200 on the 10th trade? Are you in profit? Because if you say you are, then clearly you're not very good at maths and you shouldn't be trading. Here's the other thing, guys. The market is more subjective than you will ever believe. It's not an objective place. The markets are not fractal. They're not algorithms. They got nothing to do with that. That's all about the charts. That's all about the things that you take high probability trades on. That's all about the squiggly lines. You know what the maths is? Is they've created a system so that you can see charts going up and down, so that you can see where the money lies in the market, so that you can see what other traders are doing in the market. So you can see when people are buying and you can see when people are selling, so that you can see where the liquidity is in the market. Who do you think designed all these charts? Who do you think put all these charts together? Big institutions, big traders who wanted to see where the money was and to make it easy for themselves to trade. In the old days, people used to trade. Guy would stand on the floor and he'd shout buy and sell. And it was really complicated, little slips of paper, whatnot. Now it's all done electronically, it's all done algorithmically. And now suddenly everybody in the world thinks that trading's easy and that trading's made up of maths. It's somehow fractal, when it's not. It's made up of traders, human beings in the market. There are people in the market that are buying and selling because the people buying think it's cheap and the people selling think it's expensive. And everybody buys into the market for what reason? Because I buy something in the market with a view to I'm going to make a profit at some stage in the future, whether it be the 5-minute future or the 5-year future. I'm looking to make a profit on that product that I'm buying in the future. Not now, not the second, not yesterday, in the future. Whatever future that might be. So if I'm a day trader and a 5-minute trader, I'm looking to make a profit in the next 5 minutes. And if I'm a position trader, I might be looking to make a profit in the next day, the next week, next 2 weeks. If I'm an investor, I'm looking to make a profit over the next 30 years. Get that? Makes sense? So now what you have to do as a trader is trade less to make more. Now, how do we do that? How does that work? The strategy is simple, guys. When you when you overtrade, you tend to make bigger mistakes and you have less information at hand. So I'm going to give you an example. If you're trading on the 4-hour or the 1 day or the 1 week, the higher you go with that time frame, the better your sample size. In other words, the stronger your information in that area. If I take information from a weekly chart, the information on that weekly chart includes everything that's happened over a week on one candle. And if I go back, then it gives me basically information week by week by week, and every single candle gives me an immense amount of information as to the direction the market is intending to take over time. And the sample size is gargantuan within that candle. But if I go down to the 1 minute time frame, my sample size is for all the traders that traded in 1 minute. So my sample size becomes tiny. So the information I've got is incredibly unreliable. Here's the basis of this. Now I've got to try and explain this to you so that it makes sense to everyone, because there's a strategy behind it that we trade as well. Trading less, what it does for you is it allows you to sit back, look at the market, get a bigger picture. To understand sample size, think of this. If you're doing an experiment, let's say you're looking at a trading system, and you want to see if it's going to work. So you take 5 traders, you put them in a room for an hour and you let them trade. You come back and 3 of them did well and 2 of them say it's rubbish, it didn't work. Now you've got a sample size. Will you start your billion-dollar company based on that information? Well, I wouldn't. Probably not. I mean, it's not really a lot of information. It's not really a big sample size. But if you took 1,000 traders, put them in a room with the same system for an hour, and you came back with a result of, out of the 1,000 traders, 700 said it's great and 300 said it's bad, suddenly you've got a good result. And you might actually start your billion-dollar company based on that information. maybe you'll want a bigger sample size. But you'll have a decent result, and that's the same as trading in the market. The higher you go with your time frame, the better the result. Now you're looking at the size of trade that you're going to take. If you take a trade with $1,000 stop loss on a 5-minute chart, that $1,000 stop loss is basically going to be over a period of, say, 10 points, 5 points, which means your sample size is minimal, and that could get taken out extremely quickly. Yes, you can make money extremely quickly, but you can lose it extremely quickly. But if you take your sample size, if you take your $1,000 risk on a 4-hour trade, that 10 points might turn into 100 points. A lot more space, a lot less risk. Well, there's risk, but the risk is negated by the size of the stop loss. Take it over a weekly, you might take that $1,000 and turn it into 500 pips, 300 pips or points. You make it slightly more relaxing for yourself. But here's the thing, guys. You probably, in all likelihood and all probability, are not going to take $1,000 stop loss on a 5-minute chart, or if you're going to take $1,000 stop loss on a weekly chart. In all likelihood, if you were going to take $1,000 stop loss on a weekly or a daily chart, you would in all likelihood probably trade $100 stop loss on the 5-minute chart. That's just the probability of psychology. So the size of your trade on the daily or weekly chart is probably going to be that much bigger. So you are going to take more risk because you've got a bigger gap 9 times out of 10. So you take the higher risk, you take that situation and you go into the trade with it with the view to making a profit. But you've got that much more space for the trade to move. And you've also got a situation whereby the trade can take longer to play out. So now you can sit back, you can take the trade, you can sit back, you can walk away, you can go shopping, you can go down the beach, you can do what you want, and you can leave the charts by themselves. So in other words, you can trade less with bigger amounts and make more money. You don't have to sit watching the charts all day. You don't have to take 10 trades a day to make the same money. Because in all likelihood, on the smaller time frames, you're going to trade smaller amounts, but you're going to trade more often to try and make that profit. And then when you get to the loss, it's probably going to wipe out all those profits anyway, and you're going to feel like you've wasted the whole day. Whereas if you swing trade, you're going to take one trade for those 5 or 10 trades. You're going to sit back and watch it play out. But you're not going to take one trade. You're probably going to take 3 or 4. Leave them in there. You got an opportunity of, let's say you take 10 trades. 5 will win, 5 will lose, and you're looking to make more profit than you are looking to make a loss, because that's the strategy. Because that's how we trade these slow trades. If you want to be profitable, and that's what I said to you you remember at the beginning of the video, I said to you, I'm going to show you how to make a profit in the markets, the profitable strategy, the thing that will actually turn you into a 6-figure trader, the thing that will actually make you money. Here's the strategy, guys. I'm going to go over the strategy so that you guys can also have the winning strategy to making money. And it's got nothing to do with squiggly lines. It's got nothing to do with systems. It's got nothing to do with any of the courses that you've been on or how to trade the markets. That you can learn anywhere. That's easy. That's psychology, getting over your fear. Wow, that's a difficult one. We all know that, don't we? Really difficult to get over the fear. How do you get over fear in the markets? How do you get over that psychology, that FOMO? Sit on your hands, be patient. There's a lot of things to think about when you do this, but the best way to do it is this. Have a strategy where you decide, that's my account size. Let's say you decide on having an account size that's $100,000. So you've got a $100,000 account. That's my account size, $100,000. Doesn't matter whether it's a funded account, whether it's a cash account, whether it's an account from the moon. It's a $100,000 account. That's your account size. Now you decide I'm going to take 1% risk on every single trade I take. That way, if I take 10 trades, I'm risking 10% of my account. That's my reasoning behind it at the end of the day. I'm going to risk 1% on every single trade, which is $1,000. Now I'm going to work out how to take my trade. So I see a trade, I spot a trade, I say I want to take that trade. First thing I do is work out where my stop loss is going to be. That stop loss has got to be at an area of invalidation. In other words, an area where if the price reaches that point, I wouldn't take that trade. That trade would be a complete, total waste of my time and your time and everybody's time and whoever's time. You don't want to take that trade if it reaches that point. That's the point where you want the stop loss. Because otherwise, I'll be taking the trade from your stop loss because that's probably a good entry point. Put your stop loss at an area of invalidation where you see, listen, if the trade gets there, there's nobody taking that trade. Everybody's getting out. That's your stop loss. Now you work out how much, how many contracts, how many lots can I buy between that and the cost to make up the $1,000. So how much is $1,000 back to that cost? Now you know the size of your trade, how big it can be. Then all you've got to do is determine if you can make at least maybe 1.5 or 2 to 1 on the trade. In other words, can I make $2,000 on this trade? Look at the risk to reward. We don't just go, oh, I'm making 2 to 1 and just put the target there. You want to have a target that's achievable. You've got to look at that and say, will this trade reach that target? Is it possible? And if it looks like a good trade and it looks like a possibility, then you can take that trade. Don't look for trades where you're risking $1,000 and you can only make $300 profit. What's the point in that? You're wasting your time. The trick here is if you're going to loss, you do not dollar cost average. If you're going to loss and it gets to the stop loss, what did we call it? Invalidation area. Do not move the stop loss. It's an invalidation area. You decided on that when you took the trade already. You said, if the price gets there, I don't want this trade. Take the stop loss. Learn to lose. Learn to lose if you have a stop loss. You cannot be moving stop losses away and increasing the size of your losses on the trades, because then you might as well be scalping. You might as well be just wiping out all the wins before. The strategy is take the loss. Now, if you're going to a win, now you have to learn to sit on your hands and not take the $300 profit. You have to let it go through the profit. You have to let it go through and start heading towards your target. You can move your stop loss up to break even when it's above the $1,000 level or up at that area. And then as it goes further up, you can move the stop loss up into profit and you can work out what you're comfortable with in those areas and what you feel best with. Learn to follow your trades up before you start adding to your trades. Once you're comfortable following your trades up to take profit, then you can start adding to the trades as you go as well. But first, learn to follow the trades up with your stop. When it gets up to take profit, don't take profit. Just put your stop loss right up there behind it. And if it comes back and takes your profit out, you pretty much made your profit. That strategy will make you loads of money. That strategy will make you profitable. Don't worry about the system. You can go, you've been on that course that you paid $5,000 for. They gave you a system. Use it if you want to. Use my system if you want to. Use any system you want. Put a system together that works for you, because the market's a 50-50 game. If you take a trade on any system, there's a 50% chance it's going to go in your favor and there's a 50% chance that it's going to go against you. That's how the markets work. You know why? Because the market's made up of traders, not squiggly lines. People are buying and selling. And you know what? Every single trader in the market wants to win. Everybody wants to win. I don't know anybody out there who actually wants to lose or gets into trading because they want to lose. That's not what trading's about, is it? I hope that helps you. I hope that will make you money in the markets. I hope that strategy will get you ahead. Guys, there is a free Forex book down in the description. Go and grab it for yourself. Go and enjoy it. Download it. Have a bit of fun. While you're there, if you do want a funded account, there's a link there for that as well. There's lots of other things there that you can grab to support the channel. And don't forget to subscribe and like. Please share the video if you like it. Let other people see us as well. I'll see you next time. Join us for the live shows. Check the last videos. Cheers. Ciao and bye.